Radio for a really great future. We're talking real money.
Hey, welcome back to the Talking Real Money radio show and then eventually podcast. I am one of your two hosts. Been one of your two hosts for Talking Real Money for a very long time, like 15 years. And we've done thousands of shows, and we appreciate you for helping propel us into consistently the top 100 investing podcasts in the country.
Thank you.
We really appreciate that. I'm Don. Over there is Tom, and you're there. Thanks for being where you are. We talk about money, and we spend a lot of time during our week, every single day really, reading a lot of articles about investing and about managing money, trying to find things that are different, unique, things that we can really wrap our heads around and think are great, and things that we want to rebut. And Morningstar is a great source of educational
It's all free. You can just go right on there and read it.
Yeah. It's good stuff generally, but again, not all the time. And every year they do a 5 of the best ways to invest money. And they just came out with one recently. 5 of the best ways to invest money. And in the broadest of perspectives.
Yeah, I do. Actually, I like can I give the 5 now?
Yeah, you are just game to go.
By the way, the author didn't say the best 5. She said 5 of the best.
The best, right.
Yeah.
Right, 5
But these are general. Then we'll get into the part where we disagree with her. Because, number 1, she says balanced funds. That's a mutual fund or exchange-traded fund that has some money in stocks and some in bonds.
Yeah.
You don't want to worry about it. Money goes in there. Now, I mean, it will stay that same ratio forever because they rebalance it for you. So you don't have to worry about that. But the one where they do change it would be number 2, target date fund. So as you get older, a target date fund will reduce its exposure to stocks and increase its exposure to fixed income bonds, right? So less risk as you get older. Okay. Those 2 I love.
Keep going.
Total market index funds. Now, you've heard us talk about these before, VT and the like. Love it. By the way, the biggest exchange-traded fund now has been piling the billions in is VOO, which is Vanguard's S&P 500 fund. So that's a total market index fund, low cost, own the index. Then it gets a little more complicated. Number 4, a 3-fund portfolio, which is something I think we've offered.
Oh, we suggest those all the time.
We have it on our website, I think, right? Can't you get a 3-fund?
Yeah, absolutely.
Yep. Then even more complicated and a custom fit portfolio, which I used to have when I was on television.
We offer those at Appella.
We do. Yeah.
They're custom fit. So we agree with all of those broad categorizations.
The question always is how to implement those for yourself, because when you start to boil it down into which balanced funds, for example, when you say balanced fund to me, I just think Vanguard's balanced fund because it's low cost balanced index. Thank you. Because it's low cost. It's okay diversification. It's really just U.S. large.
No, it's great diversification.
I think it's just U.S. large.
Compared to some of the other suggestions they gave, it's great diversification.
And it's low cost and it's done just fine. Yeah. Which ones did she recommend? I can't remember now.
Oh, I'm gonna let me pull that back up here. I got it right here. I was just getting out some of the funds.
3 great balanced funds.
3 great balanced funds for 2025. Get this. I don't like any of them. Rowe Price balanced. Well, it's only been around for 5 years and it's actively managed, and it has. So we only have 5 years of return to compare. So I won't even compare 5. I won't do it.
That makes sense.
50 basis points management, which is ridiculous when you can get it from Vanguard. Yeah, you can get it from index funds for less than 2/10. The other ones were the T. Rowe Price capital appreciation, which really is it's still a balanced. It's more aggressive.
Yeah, it's
very aggressive.
More of those stocks that they believe will do better.
Right, and it's a very focused portfolio. It's got about 200 securities in it, so it's not gigantic.
And then one you may know because it's been around for a long time, the Vanguard Wellington.
And Vanguard Wellington still has a higher expense ratio than the index.
I would just own the Vanguard Balanced.
and it's actively managed again.
You don't have to ask where the beef is on that one. I'd move right down.
Yeah, so that's one of the areas where we disagree. There are a few others that we're going to get to, but one of the things we have to get to is a break, and we'll save this for a little later in the show because we have a phone call, too.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
And just quickly, the funds they suggest for target date are the American funds, target date funds, the T. Rowe Price, and the Fidelity. They're all actively managed. Yeah. I just looked up the American 2035.
How much?
And its annual expense ratio is 0.7, 70 basis points.
I think you can get the Vanguard version for like a fifth of that, or maybe less.
Vanguard
2035. I mean,
target retirement.
Remember, target date fund has stocks and bonds, rebalancing to the allocation and generally moving to less risk.
0.08.
Oh, that's almost 1/10.
It's almost 1/10.
No expectation that's going to make a difference in terms of paying them more. So, again,
we'll come back to a little more of their
general
advice.
Good. Specifics, not so much.
Well, and okay, let's just do the last one that I really have a beef with.
Ooh.
I really have a beef with
this. Gets back to the Wellington thing?
No, they're recommended asset allocations for a 3-fund portfolio.
I don't even remember that
Did you
part.
read that?
Okay. Here we go.
Years to retirement. They're saying if you have 35 to 40 years to retirement, you should have 55% of your portfolio in stocks.
You should have what?
55% in stocks. The rest fixed. No, I'm sorry. 55. Oh, never mind. I misread. 55 U.S., 40 non-U.S., and 5 bonds.
Oh, that's
so
okay.
That's about right.
That's okay.
That's okay. Yeah. Then they go to 20 to 25 years. They want you to have 20% in bonds. And then at 2 to 5 years, this is where I wasn't really happy, is for most people, this is too much. They want you to have 50% of your portfolio in equities.
There is no right answer because you are different than everybody else. If I just met with a couple today they're in their late 40s, early 50s, pretty low risk quiz scores, and I'm going to recommend they probably do something like a 70-30, but hard to know. I mean, but when you give it to somebody else and you say, here's how old, and then build the portfolio that way, that's not always the best way to do it.
And what this does is it contradicts their advice on the target date funds, because, for example, the target 2025, that's for people with 0 years to retirement. Is that correct?
I believe so.
0 years to retirement, and their portfolio is we're zeroed out, and they're doing 50-50.
50. I mean, this is the part that I struggle with, because if you're 65 and you're retired this year, you could have 30 years ahead of you. Don't you want to still have some growth? I think you do.
Well, but you see, but on the other side, I see it from the other way.
Yeah.
I mean, you still have 50% growth, but do you want? This is where we have to know
That's
you,
what
and
I'm
this
saying.
is the basic problem with target date funds, with balanced funds, with 3-fund solutions, is they all assume that all of us at a particular age are exactly the same.
Not. Yeah.
And that is the bottom line. We are not the same. That's where it becomes so important to understand what your risk profile is. And profile is a broad term that takes into account your need and your tolerance.
Yeah, I think that's excellent advice. Finally, after 15 years, you said, or something. So, good job, man.
Time.
Yeah, okay.
All right, let's go to Mill Creek, Washington.
Mill Creek.
Sandy, welcome to the show.
Hi, it's Sally.
Oh, I'm sorry, Sally. It says Sandy, but also
she's not
Sally,
sorry, Sally. She's just
you.
Sally. Hi, Sally.
Hi, that's okay. Sally's okay. I mean, Sandy's okay too. My question is, we have a 401k with Rowe Price, and my husband's going to be retiring next year around April. They said we have a very good diversity in it. I'm wondering, do we leave it there, or do we move it to Charles Schwab or Vanguard or somewhere else? What do you suggest?
Are you going to manage this on your own?
Yep.
No, I don't want to manage it on my own. I like the way Rowe Price is managing it, and the way they said everything. I was very much diversified in it. I do like that, but I'm just concerned because he's going to be leaving the company, so I don't know what they're going to say to us if we have to leave or what to do.
Well, you won't have to leave.
Let me ask you a question first, Sally. Yeah, you don't have to leave. Do you have a statement at hand?
Oh gosh, I have my whole thing at home. I'm in my car listening to you guys.
Oh, you're in the car. No, you wouldn't have it in the car. You wouldn't.
But do you remember any of the funds?
I would love to see what they have, just to see if they truly do have a well-diversified portfolio. But my beef with Rowe Price isn't that, really. It might be, but my main beef with Rowe Price are the fees with their fund fees.
Going to be more expensive than the stuff that we want you to use.
They are going to be at least twice as expensive as funds or ETFs from Vanguard, Avantis, Dimensional, Fidelity. They're just a lot more expensive. Rowe Price is a fine company, but they charge a lot,
and they don't
for their
This
fund.
is one of the issues I have with the business. You don't know that, Sally. No offense. Most people don't because they don't make it readily available what you're paying on that. So I'll give you an analogy. You're in your car. You could now drive down the street and fill up for $4.50 a gallon or whatever it is, right? Say $4, right? Or you could keep driving because you like the shiny Rowe Price on the gas station and pay $8 a gallon. Yeah, I think you're going to want the 4 because it's a commodity in today's world. The funds have been commodity. You can get good indexes, you can get good diversification, and you can pay far less. But back to your other question, too, the reason I would prefer to see you move it generally out of a 401k is once it's in an IRA, it's easier to access, you have better control over it, and you have more options than you would in the 401k. So that's the reason I would probably be inclined to move it out of there.
And let me give you a really great example of the fee structure difference between Rowe Price and, say, Vanguard. Rowe Price, let's just use their balanced fund because it's a nice 60-40 portfolio. They're very similar in their structure. The Rowe Price balanced portfolio has an annualized expense ratio of 0.6% per year.
Which sounds small.
That doesn't sound like a lot. But Vanguard's balanced index has an expense ratio of 0.07%, almost 10 times lower.
That
so that $4 a gallon of gas just went to 40.
Okay. So what kind of IRA would I be looking for, and with what company?
You could do just a regular old transferred IRA. What you would do is you would contact the company you want to work with, whether that's Schwab or Vanguard, somebody who can get you into and who will get you into indexed or relatively passive exchange traded fund products like those that we suggest regularly on the show. You go to one of them and you tell them we have a 401k that we are ready to transfer into you. They will then, you can do it online or you can do it on the phone. They will then get all the information that they need to move that money over for you. You won't have to do anything after that point, except sign some papers probably.
Okay. And so when we do switch it over to, let's say, Charles Schwab or Vanguard, which one would be best, Charles Schwab or Vanguard?
That's hard to say. But
it's hard to say. Personally, I like some of the services that I think are more I mean, I could have either one, and I'm with Schwab because I think they just offer me a lot of really good services, and I think Vanguard
They built
lacks
a
little
business
bit.
as a custodian that is better, I think, than Vanguard. That's how I'd say it. But either way, you'd be okay.
I mean,
okay.
but either way, you're going to be totally happy. You're going to be just as happy as you can be, and you're going to be paying fees that are a tiny fraction, at least 50% lower. 855-935-TALK. That's our number. Call us.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And we really, truly love answering questions. We answer them on this show every Saturday at 855-935-TALK, 855-935-8255. And we also answer them on our podcast, including a special Friday Q&A podcast.
I thought it was
that's
Thursday.
Just
okay.
Q's and A's.
I'm talking about the internet one, the different one we're doing. Yours is Friday.
Yeah, that's a different one. I'm talking about the regular Friday one.
I'm confused easily. You know that. So okay.
Fridays.
I love Friday's podcast.
He's been watching his wife work out in the yard, and he's feeling bad because he can't turn a wrench.
And so, as a result of that, I'm gonna say happy birthday to my mother-in-law Patty, daughter Chelsea, and grandson Cole. All birthdays within like 3 days. So happy birthday to you all. And thank you, Danielle.
They're not listening.
Thank you, Danielle, for putting together the wheelbarrow.
Do you honestly think any of them are listening?
No, but my wife is listening, and she will tell them that was.
She is listening?
Yes, so she had to
She
go somewhere.
listens like-
she had to go somewhere in the
Does
car.
she listen too?
No, only.
Oh, so she's listening to us in the car. Okay, Tom, that's why you haven't said anything. Okay, I get it now.
You figured it out.
You knew. You knew. 855-935-TALK, 855-935-8255 is the way to get to us on Saturdays. And then we also turn this into a podcast next week, so you'll have an option to listen back. I want to finish up on the Morningstar piece on the 5 better ways to invest. And number 5 on their list is something that we advocate, but it's a sticky wicket, as they say, and that is building your own custom fit portfolio.
And this is the part that has been an internal debate of ours, really going back 25 years.
Since the beginning.
Or longer,
Yeah.
because the idea here is, should we give you 10 funds to build a 10% here? And number one, will you build it? Will you rebalance it? Will you take care of it properly?
That's the kicker.
Hard.
That's the sticky wicket part, because you may build it.
Yep.
You might build it, although we found that you might not build
So
it.
many
that
times.
You'll kind of do a variation on the theme.
I still have X because I love X, right? Or I got into it and it's very complicated. Or, I did build the portfolio, but then the market did this, this, and this, and I didn't rebalance it because it's just a lot of work.
Or I built the portfolio, but I really don't like those kind of securities, so I'm not putting them in.
Or
bonds.
one part of the portfolio doesn't act like the others. This happens a lot.
That's the other one.
I got to get rid of that one because it went. No, that's what you should
what
expect.
did we decide? What did we decide about custom portfolios? There's only one way to do it.
We decided for you all, if you're going to be do-it-yourselfers, that really it should probably be a 3 or 4 fund No offense. Mm-hmm. I'm not very good at putting stuff together. I couldn't fix a car. I wouldn't do it.
I mean, that wheelbarrow, I guarantee you that wheelbarrow only had 7 parts.
Actually.
And he couldn't put together a 7-part
You learned
wheelbarrow.
everything you need to know.
The 7th is the wheel. You see, that's why we have an odd
I was
number.
dragging it along the ground. I couldn't figure out. Okay.
7-part. So if he can't do a 7-part wheelbarrow.
Can he do a 10-fund portfolio?
Can he do a 10? Can you do a 10-fund portfolio?
Yeah. So back to that. 3 for most people, because then you have 1 U.S., 1 international, 1 bond fund. That seems to work pretty well. Not guaranteed. Mm-hmm. When it starts to get fancier than that, then the truth is, because you're kind of asking me this, I think probably professional management for most people.
That's it.
Most people.
If you get to the point where you really need that complex a portfolio, then you're probably at the point in life when you really need somebody advising, and that is the most expensive option of the 3 too.
Because you got to pay for it.
It's going to cost you a lot more money because you have to have see, with the other ones, if you're just buying funds or ETFs, The reason they should cost little or nothing is because there's no personal service.
Exactly. No planning
They're
that
not
goes
doing
into it.
anything one-on-one for you.
You think about
Nothing.
taxes or any of the rest of it, all that stuff that a good advisor should be doing.
But as you know, if you've ever hired people, when you hire people to work with you, the price goes up.
Indeed, it does. And a good advisor should be worth it.
I use ChatGPT sometimes.
Yep.
She's cheap, but she couldn't do a lot of the stuff a personal assistant would do. I would have to pay up for that.
So back to where we all started. Yes, I think balanced funds, target date funds, sure. 3-fund portfolio, sure. Start getting beyond that, I would have a professional managing it, building the plan, doing all that stuff that fits together. So I think that's reasonable.
And paying the extra money to accomplish just that. Hey, we've got lines open for you. We have a lot of them. 855-935-TALK is the number. Call us right now.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Well, what is money? Money's just a really gigantic part of your life. It really is the fuel for our existence. It's the stuff that powers our life. It provides us. It even provides us the energy to keep moving physically every day. The food we eat, the place we live. We need money, and we need to understand it better, because if you don't, you're going to make gigantic mistakes. So before you get into a position that you might regret, it's not going to hurt to give us a call, either right now at 855-935-TALK or on Saturdays, or go to talkingrealmoney.com and send in a question either verbally or type it in. So there's so many ways to do this. And let's go to Seattle, Washington right now. And Lynn, you're on Talking Real Money.
Hello. Thanks for taking my call. I'm going to try and not use any names here. We work with a financial firm in Bellevue that you guys would be extremely familiar with. We love the gentleman that we're working with. He comes up from Portland, and we deal with him that way. But the problem is I'm kind of wanting to jump off the roof here because of the company that they put our money into. And this particular company, we have seen with Mr. Trump, when they did we called it corrupt graft, and earned all that extra money. And one of the gentlemen in the White House with Trump is the guy that owns the...
Oh, okay. Well, now you told me everything I need to know.
They put your money in Tesla, I take it.
They put your money in Tesla.
Okay, we figured that part out.
No.
Oh.
No.
SpaceX.
I did try to get that off of there. But no, this is this is where they put all our money. So
the custodian.
You can say it.
Why
you can
not?
say that
Sure,
part out loud.
sure.
Just don't give us the advice. We don't. We can skip the advice. Oh, they put it in Schwab. Okay.
I don't know Schwab's relationship
So
with the president or Mr. Elon either, but okay.
Billions that they wiped off of after what happened. So the long story short is my husband really, I kind of get the feeling, doesn't want to leave. We both really like the gentleman we deal with. We liked him a lot. But I have such a problem with what happened. Now, I'm not so naive as to think that he's the only one of people that made a lot of money off of this little happening. So I need to know that we should just stay there, and that it's
one, you should probably stay there, because here's the thing. I get that politically we get very angry at people and products, but the fact of the matter is, I'll give you a great example. One of my favorite products in the whole, or many of my favorite products in the world, are made by Apple. Tim Cook cozied up to Trump.
Yep. Along with some other.
Why did he do
other
it?
Tech bros. Yeah.
Yeah, he did it because
survival.
He's got to keep his stock price up and his products coming in. So sometimes you have to bend the knee, as they said in Game of Thrones.
Exactly.
Even though you don't want to, and there are a lot of distasteful things that a lot of firms with whom I personally deal. I just don't like them, but their products are good. And I don't want to cut off my own nose to spite my face because, honestly, they're not going to notice anyway.
Okay, but the question to you still would be, Lynn, where would you take the money where they've been, perfectly apolitical, where they haven't got involved in anybody? I think it'd be hard to find anybody. I mean, you could, I guess you could say Vanguard maybe because they're owned by the shareholders themselves. So I guess they don't, but I don't know where you'd go to find somebody who's never made a mistake like that in the past, I guess.
I don't think several billion is a mistake. I think it was pretty much graft. But the deal is this. We love the guy we deal with. We love the company we're with. We are going to go see him pretty soon. He's going to be up in Portland pretty soon, and we're going to make an appointment and go to see him. But, we aren't wealthy. We're by no means wealthy. We are both retired now. We were to leave, they wouldn't even notice. I mean, that's how unwealthy we are.
I got to tell you, if you had $100 million and you left, trust me, they wouldn't notice.
That's not the reason to do it. That's not the reason to do it.
That's not a good reason. You have what everybody should have with an advisor, a relationship that you cherish, that you think is valuable. And I wouldn't let a political dispute get in the way.
Talking real money.
You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Your guides to a really great financial future. Tom and Don are talking real money.
Wow, we're in a very strange political world. Honest to goodness, I've been in this business a very long time, talking to people on the radio or on podcasts, and I can never remember a time when somebody wanted to change their investments because of their political differences. I mean, I know we've had socially responsible investing and environmental investing and things like that, but I just it's a very strange
and specifically
time
a custodian. I never heard anybody want to move their money from A to B because they were unhappy with something.
And if you chose Fidelity, I looked it up. Fidelity gave money to Trump.
I mean, they probably all give money to both sides because they're no dummies.
Exactly.
Guess what? Hedge my bets.
I looked at Vanguard's giving, and they didn't give any to Trump, but they did give a lot. They give half to the Dems and half to the Republicans.
Gee,
I think they split it in half. 855-935-TALK. We would love to try and help you manage your money better, and we've got lines open and lots of time remaining. So give us a call, 855-935-TALK, 855-935-8255. One of the biggest purposes of this show is to help you get to that thing called retirement.
Which neither of us are with more money. Neither of us are going to do, we've decided.
We've decided we're not retiring.
No, we already publicly have stated.
Die at the mic.
Pretty much.
I honestly, I think that would make for I think we'd get more listeners.
Dramatic. Yeah.
As long as somebody could figure out how to come in and edit the thing, because I'm the one who edits it all.
Bad. So I have to go first, then, is what you're saying.
You have to go first on the air. Yeah.
Okay.
And you're younger than I am, so you got to take worse care of yourself.
Starting today. Get the cigars out and let's get to it.
But we've always thought it was a little bit strange that the retirement age in the United States was kind of arbitrarily established, almost 100 years ago at 65 years old. And it really hasn't been adjusted. And back in the 1930s, when this was established for Social Security and the like, we generally died, at least men did, right around 65.
Yeah, so you didn't.
So that was probably a good time to retire.
Didn't get anything.
But now we tend to live a little bit longer, although you women live much longer, thanks to the fact that you kill us off.
Wisely so.
That's my theory. That maybe the retirement age could be raised.
Yeah, I mean, in the country that's known for what? The Little Mermaid statue and and Legos. Denmark this week decided to raise their retirement age to 70 for people born after 1970. That's a ways down the road.
That's a ways down the road, because 1970 you'd be 60. You'd be 55 today. 55. Yeah, 55.
70 plus. Yeah.
So you're telling them instead of getting out of work in 10 years, now they got to go an extra 5.
Yeah. And remember, they tried this, didn't they? Propose this in France? I forget what happened. They tried to burn the place down, I think.
They did, and they exactly France. There were riots.
I mean, and here's the thing that you mentioned something about people living longer. Well, they kind of are living longer. A lot of these,
particularly in Scandinavia,
and a lot of these countries have a lot of people on pensions, more than you get in the U.S. So they've been kind of like, well, we'll probably get ahead of this and fix it. I mean, that separates them from our Congress. It's just going to, I guess, wait on Social Security until the day before the fund doesn't take enough in to pay out all the benefits. But so this is an interesting moment around that thing, retirement, Don, because everybody is going to have to make an adjustment for everybody to finance everybody's retirement at the end of the day.
Right. It's all about a finite supply of money is what it comes down to. And by the way, I didn't even keep up with this, but despite the riots, in 2023, France did raise its retirement age from 62 to 64.
So you and I would be long retired if we're following the French rules.
But again, that's because that's really just to get a government pension.
Yeah. Okay. Fair enough. I think that's the same thing here in Denmark too. They're talking about, but.
To get a government pension. Yeah.
So, I mean, the question is...
we found in this country that pensions are incredibly expensive. They have taken down companies. Yep. They have destroyed nonprofits because we didn't anticipate, one, how long people would live, and two, how expensive they were going to be.
Well, I think you can be honest and say, three, they were not well managed.
No, they were horrible.
The money came in, a lot of poor things were done. How many pension plans have, 80 people between the person putting the money in and the actual coming out the other end? It's ridiculous.
Oh, you mean the overwhelming levels of middle management in
shocking.
most companies?
And outside companies and firms reviewing the previous firm and making sure, get rid of all that. I think there's one state now where the guy just invests in a few Vanguard funds, and that's that. Way better system. So, anyway, I just found this interesting because this is part of the continuing debate, and they're out ahead of certainly where we are, because this is something that's going to have to be done. What Social Security now is going to, it's not going to go bust, but it's going to have less coming in than it's paying out in, I think, 9 years. So relatively soon.
And if American politicians want to solve the problem, then somebody's got to step up who's a little bit more brave.
Yeah, and that's what you had to be here.
And it doesn't even require the kind of change that would
There's one,
would cause
we've talked
rioting.
about this one easy fix. Now
there's the easiest fix of all.
I know what everybody who hates it's going to say. You're raising taxes. Well, yeah, you kind of are.
Yes.
Yeah.
Yes.
Yeah.
Yes.
But on income above basically $200,000. Basically.
And what it's doing is making everybody pay what everybody else is paying, no matter how much you make.
Good point.
Because it's not really raising it. The taxes.
That's what they're going to say.
The tax is there for every working American until you hit $180,000.
Yeah, is that
170,
whatever it is. Yeah, I agree. And it would affect me, and it affect Don, and we're willing to pay more. And I pay plenty in taxes anyway, but I'm willing to pay more because this is that important. It should, and we didn't start this with this in mind, but this is the direction we're headed. All I'm saying is, thank you, Denmark, for thinking about these things in advance, not waiting until the last moment to take action.
Basically, you're saying, thank you for setting a good example for the rest of the world.
But I know we're going to get a lot of grief for this.
We are. And by the way, the limit for paying Social Security taxes through deductions is $176,100. Anything above that is not taxed for Social Security purposes. And that, to me, just doesn't make sense.
And if you get rid of it,
it's not like raising taxes. It's just saying, no matter how much you make, keep paying the same tax that you paid before you got to that number.
And if you do that, that fixes the entire problem.
You don't have to do
No,
anything else. You don't have to raise the age.
I know.
You don't have to. No, it totally solves the problem.
It's hard to imagine it that simple, but it really is. So we'll see.
I don't understand why our Congress can't
I guess
do that.
keep buying those Legos and supporting Denmark.
855. Oh, never mind. I'm not even going to give you the number. I thought we were earlier in the show, but no, we're coming up on the end.
Denmark,
This is the
Norway,
final
and
stretch.
we're ending.
Tom and Don are talking real money.
Ryan Reynolds here from Mint Mobile. I don't know if you knew this, but anyone can get the same premium wireless for $15 a month plan that I've been enjoying. It's not just for celebrities. So do like I did and have one of your assistants switch you to Mint Mobile today. I'm told it's super easy to do at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. Intro rate first 3 months only, then full price plan options available. Taxes and fees extra. See full terms at mintmobile.com.
For your real life and real future, Tom and Don are talking real money.
I have a favor to ask all of you because of today's show and next week's podcast, which is this show. Because we talked about two kinds. In the first hour, we talked about cryptocurrencies, and in the second hour, we did get. It wasn't even political, but some people are going to say we got political.
Yeah.
Okay. Here's what I would like to ask all of you who said, we had several of you who said, we really love the show. If you haven't gone to Apple Podcasts and left a 5-star review, okay, you can go to 4 if you want, but 5-star review, you don't even have to type anything. Just leave a 5-star review on Apple Podcasts. They're the one that counts. That's the one that counts. You can, now, a perfectly legit criticism is that, like this one guy who says that our behavior is like high school or junior high punks.
That's pretty close. Yeah,
that is a valid criticism. Yep. Yes, sometimes we are, but they, for example, the criticism about us being political. Stop it. This is America. We're allowed to be a little political, and we were very little. We are always very little political.
We're careful.
We're really careful. Yes. 2, we believe what we believe about crypto. You don't have to keep telling us that you disagree with us. If you want to disagree with us, don't call us idiots. You're listening to the show. You must like it. Don't call us idiots in the reviews. Call us idiots on the air. We don't screen anybody out. Do we screen anybody out?
Calls. We take them.
You want to call us an idiot about crypto? Call us on the show.
There's a lot of ways to do
Otherwise,
that.
but please, to offset the bad reviews that I know we're going to get from the very emotional who listen and hate it when we disagree with them, please go give us positive reviews at Apple Podcasts. It's really easy to do. You don't even have to keep using it. Just use it once. You can sign up and use it once, and you're not going to get spammed or anything.
Is that on the internet, or how do you do that?
It's Tom. It's on the internet.
Just checking. I didn't know. If it was
have
like
you
a
ever
fruit
listened
or
to us on
so,
Apple Podcasts?
No. Yes, of course I have.
Yes, you have.
I listen to your Friday podcast every week religiously. I love it.
And where was it? Was it on the internet?
I just push a button and then it starts playing. I have no idea where it comes from.
Same thing.
Don't take me back to junior high school. I knew more then. So.
Oh, this is an interesting review. We got 2 stars.
Yeah.
But it says they're very smart and entertaining. And however, they believe that we are getting paid to push obscure ETFs that have only been around for a short period of time and have huge fees. You know what they're talking about?
Avantis. Yeah.
Yeah, they're talking about Avantis.
They have been around for a short period of time, but it doesn't matter because of the way they manage money.
It doesn't. Yeah. Right, they're not.
They didn't come up with a new idea.
Their track record is the market and the rules that they follow, and their fees are higher because it is a slightly more complex strategy. But what's their highest fee? Is it like 30 basis
something
points?
Like that, 23, 24 basis points?
20-something, yeah. It's not that bad.
Anyway, thank you for answering
if
those.
You want some help, we love helping people. Just go to talkingrealmoney.com, and you can even meet with one of our advisors for free for nothing with no sales pitch.
Had a great week of chats, so happy to have more. So, yeah.
Tom wants more before he goes on another in the long line of vacations. And also, if you have questions, well, go ask them. Just hit the contact button at talkingrealmoney.com.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.